Welcome to the On the Tape podcast. I am Dan Nathan. I am joined in studio by Danny Moses and Guy Christopher Adami. Welcome, people.
Great to be here. Yo.
What's up?
All right, listen.
Great to be here.
It is.
First time, long time.
Hold on. I'm a little bit... I'm so used to Guy bringing us in on a 1974
We're going to get there. We have a big show today.
Yeah.
We have Savita Subramanian. She is Bank of America's head of equity strategy. Danny and I sat down with her, and she had a really interesting note out this week. She was on CNBC's Fast Money with you, Guy, earlier in the week. It was another brick in the wall of worry, if you saw what she was doing there. And we had a nice little feisty conversation with her. I think she's a bit more optimistic about stocks than we are. That being said, she doesn't have a price target too much higher than where the market is trading right now. So we go through that. We go through some of the sectors that she's most interested in.
It's actually lower than where the market is now.
It is actually
it's 4,300, but yes.
There you go.
Details. Yeah.
Right. And then earlier in the week, you and I, we did a market call from CME, our fine sponsor, out in Chicago. We were out there for a Pearl Jam concert. And usually, Guy, you get us in to the show with a lyric or a song title or something like that here a little bit. And Danny and I were at the Pearl Jam concert at the United Center on Tuesday night. And what did I say to you? I said, I got the title. I got the title.
Yep.
They were playing a song called Wish List. This is off the 1998 album of Yield. So this would be 2 weeks in a row, Guy. You picked Better Man for last week, but I heard this lyric, and I know this lyric, and I like the song, and Danny's going to sing it for us. It says, I wish I was a messenger, and all the news was good.
I was a messenger, and all the news was good.
That's really good.
And he came
like Eddie.
It was during the encore, and he played it to the back. He played it. He turned around and played it to the people because he's the best.
So, and we're going to get to, and we wish all the news was good. But then the second line right after that lyric, Guy, this one was for you. Eddie was speaking to you. I wish I was the full moon shining off a Camaro's hood. Exactly. And I was speaking to you. Didn't you have a Camaro back in the 70s, back in high school?
Don't dax me on this Camaro stock.
Okay, yeah.
A Camaro. But I understand what you're doing there. You figure, I know, I'm Italian, I'm Sicilian. All Italian, Sicilians have Camaro. I understand what you're doing here. That's called, what is it, stereotyping.
All right, I'm sorry about that.
But I hear you. It's not. No, it sounds like a good song, though. Who is this?
This is the Pearl Jam. All right, let's get into wishing all the news was good, okay? So the stock market until this week, over the course of the summer, August was a little rocky, and we did have that kind of melt up into the Labor Day weekend a little bit. But, some of the news out of China, and we've been talking about this now for months, okay, the economic data is not particularly good, right? And now the saber rattling guy with U.S. companies, okay, we talked a little bit about Gina Raimondo going over there, our commerce secretary, to China. It didn't seem like there was a whole heck of a lot of progress made. And then you come back, and I think this headline that the Chinese are going to ban, the use of iPhones by government workers. That's taken off 8-9% market cap off of Apple, which started the week at $3 trillion market cap. Talk to us a little bit about this, because this really feels like a massive shot across the bow for U.S. multinationals.
Well, it's another salvo, and I will say this, I'm choosing to use this word. It's actually embarrassing to see the amount of people that we have paraded out to China to sort of try to ease the tensions that have grown. I mean, it started with Anthony Blinken. I think John Kerry went over there, then Janet Yellen, God only knows what she was doing there. And as you just mentioned, Gina Raimondo there over the course of probably 6 months. And what seems to happen is, they come back and say how great everything went. And then in the weeks or days subsequent, one of these axes types to fall. And this is a clear escalation, in my opinion. And I have said it on Fast Money for a long time. I've said it on our shows that my concern is that the Chinese will escalate. They will ratchet up the rhetoric, and the biggest bullseye on the biggest company will be Apple. And I will tell you, I'm shocked that Apple didn't fall more than it did over the last couple of trading days. And we'll see. Maybe we're in the midst of something. But the existential risk, in my opinion, for Apple is something like this to continue to escalate in China. And to say it's not a big deal, it's a big deal. And, oh, by the way, Dan and Danny, and you both know this, Apple was an expensive stock going into this entire thing. So when you layer this on top, it does not paint a rosy picture.
Yeah, I mean, so Danny, we've long said that the last battle fought will be Apple when you think about the really close ties. And Tim Cook has spent 20-some years developing these ties as it relates to orienting their supply chains around there. And just, when you think about what an important engine for growth this Chinese middle class has been, that's a big part of it. Obviously, cheap manufacturing is the other part of it. They get 20% or so of their sales from China. I mean, the fact that this isn't the last battle fought, it's actually, they went for the big kahuna. We've been threatening to, TikTok and the like, and Huawei is a big one for them too. But this is a big deal.
Yeah, listen, I think to the point you just made, it's an expensive stock anyway. The iPhone 15 launch may fall flat anyway. And yeah, we know that the geopolitical risk is being mispriced. It has been around the world, not just with China, but this always brings it to kind of the headline and makes people think. But in the middle of all of this, the data out of China, forget about Apple for a second, continues to be bad. So if the Chinese consumer's in trouble, Apple sells to the Chinese consumer on top of obviously manufacturing there. The head of Foxconn just resigned, or the chairman of Foxconn just left to run for president of Taiwan, obviously. I mean, I don't know if that's symbolic in nature or more if there's something else behind that, but Foxconn's business ain't great. We've known that for a while. So it's not like Apple's quarter. Let's go back to the last quarter. It wasn't a great quarter. No. We know that. So I think a lot of people use Apple as a short in kind of the long short books in tech, feeling like it's not one of these things that can get really memed from here like some of these other names can be. So we'll see. But it's feeding on itself for sure.
Carter had a note out today or Thursday of this week talking about Apple's relative underperformance to the S&P tech sector for the last 11 months. And to your point, I actually do think it is a bit of a source of funds. When you think about how much of those shares are locked up, I think, Berkshire owns 915 million shares. You think about that, right? And so, again, I do think that is a big one. Another one here, and we've been talking about Tesla a lot. I'm going to get us into this for a second, but this is also a huge one when you think about Tesla, their expected growth out of China, the manufacturing, the access to rare earth materials, the whole like. But it's not just us who wants to talk about Tesla. And we haven't talked about Tesla in a while. The Chinese data is not particularly good for Tesla. We know that they've cut prices there about 7 times. I know they're introducing a new Model 3 on the low end. It might not be enough there. There is a deflationary spiral going on there, and they keep cutting prices for their cars with lots of competition. But here's a question from a reader. This is Walt in SC. That would be South Carolina. Big fan of the shows. Wondered if you had an opinion on how in the world Tesla is not being destroyed on the back of these comments by Elon Musk on the ADL and Twitter advertising. I think this is a really good one. Danny, you hit me about this. Some other friends of us, we got a little chain going on here. There was just a couple weeks ago, he was talking about how Twitter's ad sales were actually maybe increasing. This whole little salvo that he did just the other night on Twitter, I think is suggesting something different. They're saying that maybe sales are down 60%. I've long thought that Tesla shareholders are on the hook for all of his behavior as it relates to other companies, and specifically his $44 billion bid for Twitter. Okay, so talk to me a little bit about this, because we've thought that the next buyer of an electric vehicle is somebody who probably doesn't prescribe maybe to some of his views as it relates to, political things and the like here. So this was a big one, in my opinion. And the point that Walt said that, can you imagine what would happen if the CEO of Coke or Pepsi or UPS came out and made those statements?
Listen, he's been Teflon. Elon, right? He's done worse things potentially than make those comments. And, I'll just add that there's now, you see these articles come out in the Wall Street Journal about how he borrowed money from SpaceX, approved by him, who is the board at SpaceX, $1 billion at the time, to close the Twitter deal. He's used that as a source of liquidity in the past, and kind of how all his companies are kind of intermeshed together, right? There's bigger stuff here. And then go back to the CFO resigning, right? In the middle of
So this was a few weeks ago on Friday Night Dirty, right?
Turquoise, a Friday Night Dirty, CFO resignation, all this stuff's kind of, so it's bigger than all that. Listen, he's been doing this type of stuff for a long time. The people that he's let back on Twitter and so forth. And I've gotten past that. I try to really look at the company. I've never liked the guy, as you know. I try to look at the company just on its own merits. Forget and just pretend that he's a normal person. Stock's still expensive. So to the point that they're making, I don't know what it's going to take, because if it hasn't cracked by now and all the things that have occurred, I mean, you're going to get me rolling here, and I'll go back to money that he borrowed, right? To Solar City borrowed, I believe, from SpaceX at the time on a loan. And then what happened? Tesla ends up buying Solar City, right? Because there was a margin call. I mean, this type of stuff, granted, that's not comments about the ADL in general, but nothing surprises me from this guy. He's basically made comments against every person in society at this point, I want to say. So leave it at that.
Yeah, and Guy, I mean, specifically the questions as it relates to Tesla, as the only publicly traded entity, right? And so, I mean, again, I don't think he'd be doing this if this was a publicly traded, Twitter was a publicly traded company. I just don't think it would. I mean, I don't know how that stock would be able to hack it in the public markets.
It's interesting. Obviously, as Danny mentioned, he plays on a different playing field than everybody else, and that works obviously until it doesn't. And I think at a certain point, it's going to catch up to him vis-a-vis the market. So let's just look at it through the lens of Tesla, which, by the way, here at $250 is still significantly lower, some probably 40% or so lower than the all-time high the stock made in November of 2021 or thereabouts. So the fact that the stock rallied from that 108-ish level that we saw in January of this year is interesting, but you're still talking about a stock that's still in a pretty significant downtrend. And it appears as though we're on that next leg lower. That's just my opinion. They continue to cut prices. That's not good. And again, what's going on in China, obviously you can say it's not a big deal. It's a big deal. That tailwind is going away. The tailwind's becoming a headwind. And, you can speak to this. Danny can speak to this. And I want our listeners to think about it. It's one thing to cut prices if you think you will make up for it on the volume side of things. But if you're cutting prices and the demand's not there, things are going to happen very quickly, and those margins will continue to contract. A lot of people thought we saw trough margins for them last quarter. You know what? If they don't come in with something north of 17.5%, 18% in terms of margins, there's going to be a problem because people are going to start to say, wait a second, they're going to fall victim to the same thing that the legacy automakers have, 16% or so margins heading the wrong way. And I will tell you, that will not be good for the stock.
Well, there's massive call buying going on again, right? Every time there seems to be bad news out, there's, remarkably kind of a call buyer that's out there, just massive, that are expiring literally tomorrow. They're being bought right now. So, see what happens here. But
all right, here's a couple dueling headlines from the Wall Street Journal on September 7th. That would be Thursday. And I think this is actually the most interesting headline I read all this week, okay? Walmart cuts starting pay for some new hires, okay? So I think, Danny, you introduced this into the show notes here, into our rundown here. Walmart is paying some new store workers less than it would have 3 months ago, a sign that employers are seeking to cut labor costs. Employers are seeking to cut labor costs as the once hot market for hourly staff cooled. This was a big part of this whole narrative. Now, the other one, okay, I think this is really interesting from the Wall Street Journal. Health insurance costs are taking the biggest jumps in years. So think about that, okay? So companies are actively, we know that once they'll have to start cutting jobs, right? If they're starting to cut the wages, they're going to start cutting jobs, especially as health insurance costs and other costs are going up. And this is health insurance costs. This thing has been going on for years.
So there's a lot in that, and there's a couple things I'll comment on. Walmart, if you read what they wrote to their employees, they say that they're giving them the opportunity to do a lot more jobs within the company, be a cashier, stock, do whatever, so they have a chance for improvement within the managerial process. Basically, what they said is they're going to go back to minimum wage, whatever the state is. Like New York's a different minimum wage than Oklahoma, whatever, $14, $16, $17. But you're right. I think it's a way to kind of shield. Your second comment is interesting. So the health insurance market and the property insurance market. You can calculate inflation. I don't care how it's calculated into whatever. Those are pretty much must-haves for whether it's car insurance or health insurance for most people. The majority of people get health insurance through their companies. Those proposals come out now, right, for 2024. So what's happening is you're seeing market increases. Why are you seeing market increases? Because during the time of COVID, there was no hospital visits per se, your normal surgeries, normal hospitals. Hospital costs were down. Now, with COVID kind of being behind us, hopefully for the most part, and people getting back to normal, there's more hospital visits. So they're blaming it on the hospitals that are charging the health insurance companies more than now passing it on. So the employer has a choice. Pass it on to you as an employer, eat it. Right? So either way, you're going to hurt the margin or hurt the consumer. But the second thing, homeowners insurance and property costs, all the catastrophes going on, that's going up too, way above the rate of inflation here. We're going on. So a lot in there, but people are facing higher costs. So when you think about, I'm obsessed with the 10-year, I'm obsessed with mortgage rates, these are everyday expenses that can hit the consumer. Look at United Healthcare stock today, right? I mean, obviously, it's a huge part of the Dow versus the S&P, and that's why the Dow was up and the S&P was lower. But again, you can own these companies if you think that people can absorb those costs.
So, Guy, you've been talking about pesky and persistent. Okay, so energy costs are not down that much. If you look at the food, yeah, it's down a bit, but it's interesting that the hourly wages. You've often long said that education, housing, health costs are not measured properly, as Danny just mentioned in the CPI reading. So you have the scenario where you're going to have inflation remain pesky and persistent, but if you have low-end wages start to drop here, and then going back to what we just talked about with Dollar Tree and Dollar Gen and some of these other retailers, that
below, yeah. I mean, it's not a good situation, Dan. No, and you're spot on to bring that up. And again, it's not coincidence, I don't think, that sitting here, we're looking at Walmart, which, by the way, Danny's been talking about forever, making not a 52-week high. Walmart is making an all-time high. And then you juxtapose that with Target, which is making, effectively within a couple dollars, a multi-year low, which is astonishing if you think about it. And it speaks to exactly what's going on with the consumer. And when you see a Dollar Gen miss 2 quarters ago, have a precipitous move to the downside, only to have it happen again, a stock that's probably now been cut in half from its all-time high, and then you hear some of the commentary out of the CEOs. I mean, they're talking about a consumer. Think about it. Typically, when things are going bad, people trade down to Dollar Gen or to Dollar Tree. Now they are trading down from Dollar Gen and from Dollar Tree. So it really makes you wonder what's going on with the consumer here. And again, I don't want to be this doom and gloom person, but it does not paint a particularly good picture.
Yeah. So earlier in the week, the FT had an article, economists grow gloomier, Guy, on 2024 as central banks delay rate cuts. So Danny, this is kind of important here. You're seeing some economic growth globally being ratcheted down for 2024. And if you think about the stock market being down in 2022, at least here in the US, it was discounting a recession in 2023 that didn't happen. In 2023, we have an S&P that's up 16%, and NASDAQ's up 30%. And now you're starting to see economists get a little less hopeful about global growth, about growth here and the like here. What's in store for 2024 with stocks here? Because again, it's been a bit of a seesaw.
Well, here's the amazing thing about that title of that article, right? If that is the actual right title. Economists grow gloomier on 2024 as central banks delay rate cuts. Well, the delaying of rate cuts could be because the economy is employment's still holding up in general. We know it's really about inflation and people look at certain things. But I mean, listen, Germany's numbers came out today. They're atrocious, right? They're in a recession that we've known. What I've been talking about for the last several weeks and several months is where is the growth going to come from outside of the U.S.? Yes, the U.S. is better than I thought. It's been strong. Where's the growth coming from? And that's the problem. Normally in a cycle, U.S. does poorly, Europe's okay, vice versa. And this isn't a crisis by any means. This is a normal economic cycle. And when rates stay high this long, like they have, right, and there's funding needs and there's debt to GDP levels that we're seeing across the globe, and the QE game is kind of over, again, reconciling with that, I think, and really coming to terms with that is kind of the problem here. So I do think we've been talking about kind of this delay. Was it going to be? Well, there are recessions occurring in various pockets around the globe right now. I don't really see a bright spot, and just relying on central banks cutting rates, right? And now it's been pushed back on Fed fund futures later in the spring next year, right? Whether it's January, March, or May, like whatever it might be, I don't really think it matters right now because what's going to get us those rate cuts? What's going to happen? It won't just be inflation coming down. It'll be unemployment rising and employment coming down. And I think stocks aren't priced for that, Dan.
And let me just jump on top of that and say, Danny talks about economic cycles, and I think he would agree with me on this one. There are no longer economic cycles. What we have now are credit cycles. And I think we're about to be, again, my opinion, I think we're about to be on the wrong side of a credit cycle. For the last 10, 12, 13 years, obviously, the credit cycle has been extraordinary on the back of zero interest rates and free money. Well, now is when things start to pay the piper, as they say. And I don't want to get all wonky here, but you're seeing it with Japan. We've talked about it for weeks now, right? And I will tell you, we will come in one day and you will read or hear Bank of Japan intervenes in the yen, intervenes to try to stop the yen from falling. And that will work for about 6 hours because that genie's out of the bottle. And as their currency continues to deteriorate, their bond market continues to sort of spiral, it has ramifications here, not only here, but globally. So the credit cycle, which was great for a lot of people for a long time, is on the other side of things now.
I want to rehash something I mentioned briefly last week that I should have given more time. And that was my example. My buddy Chaz has a key bank, right? And he's gone now from key bank, went to JP Morgan. And when you think about the corporate debt that these banks are going to have to issue now over the next 3 years, just in general, Key's debt, I think, trades at around 9%. I think it's trading at 85, whatever I think that's the yield to maturity, so to speak. So if that's the case, they have to earn obviously more than that, obviously in the marketplace on their loans. So that's the first part. The second part is this note out today that Dan McNamara, my buddy Rosie, Mark Rosenthal, who's a great credit trader, brought to light, is that the FDIC is selling SIVB's portfolio of multifamily. It's $33 billion worth of multifamily paper in the U.S. Now they're gonna take most of the risk, the government, et cetera, et cetera. There's a lot of paper out there, not just from that in general, that's going to come up for refinance that's kind of out there. And when I hear one more time about how private credit is supplying, oh, don't worry, where the banks have left, private credit steps in. Yeah, it's great for private credit because you have, floating rates that they're earning. That's not good for the companies that are borrowing. And that's, I think, the problem with the disconnect is that the cost of capital is going up across the board. This is not just a lag effect.
Yeah.
There is something structural going on within the banks that are forced to either offload certain paper. So I just think, again, I get myself all worked up and negative. There'll be things to buy. There'll be things to buy at some point, but these are the things that I think are just now working.
You weren't all worked up and negative on the pit in United Center on Tuesday night
when you're
at about
in
9:30. Yeah,
that's Field of Dreams.
That was pretty epic. So we had a little family affair there. Okay, we were with some of our friends from the CME group. Danny had his youngest son there. I had my twin brother. I had my older sister. I had one of my high school friends. It was pretty epic, guy. If we were going to get you to a Pearl Jam concert, would you find yourself in general admission in the pit?
No, definitely not. No, I mean there's a better chance that I would attend a Met game in October.
Oh, stop it!
Assuming they're still playing in October, than going to see than being in what do you call it? The pit.
The pit, dude.
Why would anybody want to be? I mean, unless you're Vincent Price.
Well, it's pretty cool because I just want to say one thing. You were on the floor, where the Bulls, the Blackhawks, and you're looking up in the rafters. There's a lot of title. That's title town. Boston's pretty good. New York's, Chicago in there, it felt like real title town.
Anyway. He gave a nice shout out to Jordan. He often does in that build. Little housekeeping note here. Okay, CME Group, our fine partners are hosting a bond trading challenge. It's called Battle of the Bonds. It starts. You got to sign up by Friday at 4 p.m. Central Time, and it goes through September 10th through September 15th. You have a 100,000 margin account of paper trading, but you trade bonds, okay, in that period of time. The winner can win $2,500. The second place, $1,500. And I think the third place, less than that. Guy, Danny, and I are all going to be participating in that. It's going to be a lot of fun. So please go to cmegroup.com/bonds challenge. The first 100 listeners who take a screenshot of the registration, email it to contact@riskreversal.com, send it to Amanda. You know the drill. You're going to get a Risk Reversal Media water bottle. They're pretty dope. So do that. Participate in this challenge with us. We've already had a lot of people sign up. We've been promoting this on the market call. That's pretty cool. Guy, should Danny give us a little pick to click here for the NFL? It's week 1, baby.
Hold on. Before I get into that, we're entering. We have a contest among the three of us.
Yes,
so
we do.
What is it going to be?
What are we going to do? The winner amongst the three of us is what do we do?
The winner we're going to do
$1,000 to a charity.
Fine. All right. So NFL kickoff this evening, right?
We're recording this on Thursday afternoon.
Correct, but I'm not picking the Thursday night game.
Got it. Okay.
Just two quick picks here.
Yeah.
I believe the Super Bowl, I like the odds of it, are going to be Philadelphia versus Pittsburgh, the Eagles versus Steelers. That's my belief. Therefore, part of that belief would be to take the Steelers at home on Sunday against the San Francisco 49ers as an underdog, getting 2.5. I want to say something about Mike Tomlin, okay? He's been coaching for 16 years. He's never had a losing season. I want that to sit in. The longest streak in history. The team was rolling at year-end, so was San Fran, but I believe in Pittsburgh 2.5. The second one, sorry, Vinny, I'm sorry, but I'm taking the Bills minus 2.5 in New York against the Jets. I just don't see it. I'm not a believer in the Jets. Yes, Aaron Rodgers may have a decent game, but I like the Bills laying 2.5. So I have one home dog and against the other home dog. Those are my two picks, but I like the Philadelphia Eagles versus the Pittsburgh Steelers in the Super Bowl. I think it's over 100 to 1. So there you go.
Guy, what do you got?
Can I tell you something? I love what you did there because we're in a pool, the three of us. They call it a 250 pool. I won't get into the granular details, but I have the Pittsburgh Steelers. I think they're going to surprise people this year. I'm with Danny. At the flip side, the Eagles still have the best roster in football. I think they wire to wire it in the NFC. I also love the Chargers. So I like what Danny's doing there. But I'm going to give you a team that I think is going to surprise people this year. And it comes in the form, Dan Nathan, of your Chicago Bears. They've been awful.
Yeah.
But you know what? They have the makings of a pretty solid team. I like what they're doing in Chicago. And I think they're going to surprise people. And that surprise will be to the detriment of a lot of you Viking fans out there. So keep your eyes on remember last year I gave you the Jacksonville Jaguars?
Yes, you did.
Nobody believed it. This year I'm giving you the Chicago Bears.
I'm short the Jacksonville in our 250 pool, and that gave me the ability to buy your Giants and my Bears guy. All right, real quickly, I'm gonna have an epic football weekend, just so you know. I'm gonna be in Boulder for Coach Prime's first home game versus Nebraska at Folsom Field Saturday morning, and we all were talking. Everybody was talking about that TCU upset. That was pretty epic.
Coach
Prime, you know prime time, Deion Sanders guy. Come on, that's what they're calling him.
Sanders.
Yes, Coach. No, they're calling him Coach Prime.
Can I tell you something? No.
Yeah.
You may.
And then
I'll never say Coach.
And then
Prime.
guy
unless his last name is Prime, I don't call him Coach. That's Coach Sanders.
Yeah.
Continue.
And then on Sunday, I'm jackassing it over to Mile High, and I'm going to see the Raiders play the Broncos. That's a good football week.
Listen, any beginning of season one,
right?
any beginning of season.
All right, listen, we covered a lot. Guys, please go to our CME, the Battle of the Bonds. Participate with us. That's going to be a lot of fun. If you're one of the first 100 to sign up and send the email over there to Amanda, contact@riskreversal.com, you're going to get a Risk Reversal water bottle. And stick around for my conversation and Danny's conversation with Savita Subramanian. All right, and we're back with Savita Subramanian. She is the head of U.S. Equity and Quantitative Strategy at Bank of America. Savita, welcome.
Thank you. It's great to be here.
You know, Danny,
yes,
Savita, we've all known Savita a very long time.
I know you've been trying to get her
and we've been
on
trying to get her on the pod. This is what I think we're going into. Like, we are, what, 2.5 years, a little more than that? Maybe almost 3 years.
Wow,
Yes.
I didn't realize
There was some ghosting going on. Maybe it was like an email blocking thing. Who knows? I don't know. But I finally cornered you.
Straight to spam.
I cornered you on the set of Fast Money, I think a couple months ago. And basically we ended the show, Danny, you'll love this, is like, we do that final trade segment. Yes. You were on for the full hour and you were brilliant, okay?
Oh, thank you.
And my final trade was, I think yields go lower, okay? And, and I was long the TLT. And she goes, oh, and that final segment, it's meant to be like a 2 comments. Yep. And she goes, oh, and she goes, oh, no, yields are going higher. Right. She said, like, matter of fact. And I said, really? I said, because I just gave my final call. She goes, you want to bet? And she bet. And that's what she did to me.
I'm successful betting against him as well.
So then a couple weeks later, I was like, okay, you win, because the 10-year was at 3.8, and I think it was just about like 4.1 or something like that. So you win, but then you lose by coming on the pod with us.
No.
Love it. You make us all smarter when we get out of here. So.
Fair enough.
I know.
Well, listen, again, like I said.
I just needed to win a bet with you in order to come on to your
Well, there you go. I mean,
you should do that with all of
By the way,
your
there's a large club of people that have won bets against Dan.
And it usually costs me money.
Sell on Madison Square Garden.
It costs me money to charities, just so you know. Yeah. All right. Let's get into it, because listen, on our pod, Danny, Guy, and I, we kick around a lot of ideas, a lot of thoughts on the markets, this and that, whatever. We often think a lot alike, and so it's really good to have some folks who like kind of challenge our way of thinking and everything like that. One of the things I think was really interesting, and I know that you've been in the strategy game for a long time, but I know you also talk to a lot of really smart investors, and part of kind of gauging sentiment is getting pushback, right, from your clients and that sort of thing.
Absolutely.
But at the start of 2022, most strategists were really bullish for the most part. I mean, I think we can all agree on that. And then even the most bullish ones threw in the towel late last year, right? And it was kind of near the bottom. And we were saying we were waiting for a lot of those folks to do that. And now it seems like people are back to being really bullish, with the S&P up where it is, up 16% of the year, the NASDAQ up 30% of the year. Talk to us a little bit about your thought process. You were on CNBC's Fast Money a couple days ago. You laid it out, I think, very succinctly. We have a lot more time to go through it a little bit. I think there's some things at odds a little bit with what your price target range is. You have an S&P range 4,300 to 4,600. We have an S&P that is at 4,450 right now.
So
that's what
bearish.
right in the range. So you lean bearish, but you have a positive outlook for the economy, and for stocks longer term.
Exactly.
So let's hear it.
And for stocks in the S&P 500, except for the Magnificent Seven.
You like the equal weight.
Basically, the equal weighted benchmark is the easiest way to express this theme. And I feel like that's a buy and hold strategy. But what's problematic right now is that the benchmark is basically two benchmarks. It's the Magnificent Seven and then everything else. And I feel like that driving force of the Magnificent Seven is the only area where we do hear bullishness from clients. This is all I hear from the equity bulls is that we've got the tech, we've got the AI, we've got the growth. Those are the new core holdings. That's what you got to own.
Well, they're easy to get in and out of, right? They're large market
They're liquid.
caps. They're very thematic. They're good companies for the most part, except maybe one of those 7. And we won't go into that one right now. But no, I can see why, and you can play a theme in them. And that's the one I think that fund managers use to express either underweight or overweight. And then it's easy to kind of get there. So I totally understand that part. But I think just to go backwards, because I was looking at research that you've written, and back in 2021, when inflation was apparent to everyone but the Fed.
Yep.
You were preparing for it. And you said selectively the two groups that should work were energy and financials. Energy's almost doubled since you said that, right? And obviously there's a war and all that stuff. The banks and financials, other than Civ B, who no one could predict it at that moment that these banks would mismanage their balance sheets, they haven't been a horrible place to be because those are traditionally the ones that kind of get some type of benefit from inflation, right?
Right, exactly.
So I know you try to be a little bit more tactical than just say buy the S&P to the point you just made.
Yeah.
So just to jump forward here, come back. Right now, when we're sector specific, when you say equal weight S&P, let's dive into some of the sectors that you like here.
Yeah,
try to be
absolutely.
constructive here.
So our overweighted sector. Let's talk about what we
do try to be. But this goes back to the Jan 2022 thing where it seemed like most strategists were bullish on the S&P 500, but there was lots of sectors that were screaming, you know what I mean? Like we were about to actually have a difficult period.
Yes.
So I do think the sector rotation stuff is very important.
It's critical, right? So we have a very cyclical tilt in our portfolio. We still like financials. I know it hasn't worked, mea culpa, but I really think that large cap U.S. regulated banks and insurance companies have been summarily discarded along with the bathwater of, risky regionals, et cetera. Regulated banks can't make mistakes. They literally aren't allowed to do bad things anymore. Right. So I think that's one area that should be working, but it hasn't. I still love energy. I think energy is a really interesting kind of a secular theme because what's happened is that all of the energy CEOs stopped paying themselves on production targets and are now paying themselves on capital allocation and ESG and all of these other goals. So they don't really want to produce, right? That's going to trip up a lot of their other compensation targets. And I feel like until we see energy CEOs go back to being paid on production, that's a sector where you're going to see supply constraints, very strong discipline around capital return. I feel like the multiple should be a lot higher than where it is today, but I don't feel like folks are recognizing this sea change in the industry.
Very important comment you made there, and I would add to that they've been around for cycles and cycles. So they were around pre-QE. Yes. They know how to manage, and to the point, they spent time cleaning up their balance sheet.
Yes.
They're not going to have the debt maturities. And now some have a lot of debt, but they have a ton of equity as well. To your point, buying back stock with cash flow generation. And on the financials, I wholeheartedly agree with you. The large cap banks, though, are in so many different buckets. If you are bullish on the markets, not you, I'm saying people that are bullish on the markets. Yeah. If you believe that means M&A is going to be coming back, the IPO counter is coming back, and you're 100% right. The big banks are going to be the winners from all the regional banks that are now basically calling in credit lines that the big banks are now getting. These smaller banks are forced to raise debt at 9%, 10%. They have to charge 12 or 13 on their loans. They're going to win. The big banks are going to keep getting bigger. So I totally agree with that. It's kind of a low risk, a little bit higher reward place to be. And they pay dividends. They return capital when they're allowed to. And I do think if the market gets a little bit crazy in terms of bond prices and so forth, that the Fed and Treasury will be more lenient with them on some of the requirements, SLR ratios. I believe at some point are going to come and relieve.
One could imagine. I mean, I don't think the Fed wants to cripple the economy by, disallowing banks from lending even further. So, I think the overhang for financials overall is just the idea of, depositors demanding more, which is, makes sense. We should all be demanding more from the banks. But I do think that, I think what's interesting about the banks is that they've been generally underweight over the last 5 or 6 years. And every time the yield curve changes from one theme to another, what I hear is a new reason to be bearish on banks. And there is no phase of the yield curve where it feels like investors think that's good for banks. There's got to be some point in yield curve steepening that's actually positive for banks. And I think that might be right around now. So there's just general kind of loathing of financial services. And I think also on top of that, we've been all kind of training ourselves to expect this massive recession that's always being pushed out a little bit. Banks don't do well in recessions. You've got to avoid them. But, again, I think we're all, I don't know, you tell me what you think, but I feel like we're all using this 2009 playbook.
Yeah. Well, you talk about that a little bit. So you have a note out on Thursday, more bricks in the wall of worry, which I saw what you did there. And it's interesting when you talk about, when you got bullish on energy and financials, it was this summer of 2021. You know where the S&P 500 is? It's right where it was in June of 2021. So the S&P hasn't made a whole heck of a lot of progress, obviously, since then. It had a really bad year last year. Let's talk a little bit about, like the macro for a second. And then I think we kind of highlighted two really important sectors, and we'll look at some other sectors. And I definitely want to get back to tech a little bit too. But let's talk about that. Let's talk about your S&P range. Let's talk about how it kind of resolves itself in a way. Are you, if we were, though, to be on the precipice of a recession, and I know you look at a lot of the leading indicators, not particularly great right now. The S&P at some point will start to discount that. It hasn't at the current valuation point, right? And so you're at $215 for 2023. Where are you for S&P earnings for 2024?
Let's call it 235.
Okay.
Yeah, I think we see a recovery. I actually think Q2 will be trough earnings if we're right about the economy and no recession, just sort of a soft, gentle landing. I do think, though, that the earnings are going to be very bifurcated. So where you're going to see a pickup and an acceleration are in some of the higher beta, more GDP-sensitive companies, because those are the companies where you've seen estimates cut and now starting to be increased. Consumer discretionary stocks, they're more underweight than they've ever been. Well, in the history of our data back to 2008. But these stocks have actually seen revisions to the point that they're now in line with expectations for consumer staples. So while everybody has gone to consumer staples as this defensive hedge, their earnings are actually starting to deteriorate. Consumer discretionary earnings are coming back. So I think that's another area where you could get some juice from being more cyclically oriented.
It's funny, though, and we're going to talk about China too, but look at consumer discretionary, a little basket. You could say maybe these are some stock-specific things, but look at Starbucks, look at Nike, look at look at how Disney's acting. I mean, they're saying something they're not acting well, and so and maybe that has to do with some other stuff here. But let's go back to this whole idea of the S&P market cap.
Can we actually just drill down on that?
Yeah.
I think the reason they're not acting well is because there is this itchy trading trigger finger. I don't know what the right term is. You guys probably have a term for this. I just invented it. But I don't think it rolls that easily off the tongue. But I feel like there's this sort of, this kind of fever pitch, like emotive response to any negative consumer news. So we got some bad earnings numbers last week. Those are, the earnings that we heard about a couple weeks ago that drove stocks lower were really just two small companies that contribute
Dollar Tree and Dollar
to
General.
the S&P 500.
Yeah, but a lot of the department stores were not particularly great. I mean,
so I think what's interesting, though, is if you look at the earnings makeup of the S&P discretionary sector, it's mostly Amazon and Tesla. Yeah. And then you take those guys aside, and the biggest contributors are actually retailers of goods to middle-income consumers. Yeah. And in our credit card data, that's the area of the market that has hung in there, is doing really well. And what's happening is that higher-income consumers are trading down into some of these medium-income plays. So I think we're kind of in that sweet spot for the S&P 500. Services spending is slowing, which is usually better for the Russell 2000 than the S&P. Luxury goods spending is slowing, but that's more Europe than U.S. So I feel like what's happening right now in terms of inflections in consumer spending is actually all kind of favorable for the S&P 500 rather than other areas. But stocks are behaving poorly because anytime we hear any negative news, like student loan repayments, I feel like that was just a red herring argument, because when you actually look at the magnitude of loan payments, they're so small relative to disposable income. It's something like 50 basis points.
But just to push back a little bit there, I think it's not just about student loans. It's credit for the consumer, well over $1 trillion at this point, and the rates are moving higher, and all the revolving debt is out there, and it is getting repriced every day.
Sure.
And in some of these retailers that have private label credit cards are underperforming, and they're seasonally underperforming. And so part of the bank's problem right here is they're going to have to reserve more potentially. The big banks will be fine. And I think that maybe is what's hurting the discretionary area. Now, we've been bullish, or I've been bullish on Walmart, because the whole trade down aspect of it. And yes, it's not a cheap stock, but I think people, and I think you agree, will pay a premium for consistency in earnings, and I think they're in a great spot. They're fine. And they have the food, huge food category for people to come into. So I think what you're describing, and I think what we believe, it's a stock picker's market. And you can find things you can own here. Yeah. It's not about buying that particular ETF, within consumer discretionary, like you just mentioned, that Tesla and Amazon are 1 and 2.
They're 45%.
Right. So
exactly.
It's hard to track those as two of the Magnificent Seven lie in it. But again, Abercrombie had a great quarter, right?
Yeah,
now, if you're tracking,
exactly.
and you've made the point, and I've talked about this, we've talked about it on the show, that you got to pay a premium, give credit to management teams which have seen cycles. And they've been through it before. They don't blame the Fed, they just deal with it. But the one thing that I want to talk to you about and really get into, and you've been doing this since 2001, so you've seen cycles, is this whole living in a world with no QE, living in a world with the reality of these higher rates. Because I don't believe people have accepted this. Forget about the lag impact. The impact's rolling. It's happening like, real time. And I think the consumer itself has been willfully ignorant to managing their personal expenses and how they're dealing with their disposable income, with the thought of, I'm going to get a check. I'm going to get a stimulus check if things go really bad. I'm not saying they're consciously thinking about it. I think they've now been trained. I think that the belief that the U.S. consumer, which is the most resilient consumer on planet Earth, always will surprise to the upside. I've never underestimate. I feel like it's different this time in terms of. So I want to get your thoughts on that. And then one other point you made, you can put this into the same category, which is the whole mortgage rate thing, which I know is not having an impact because their arms aren't out there. All these adjustable rate mortgages. However, that means the flip side of that is that when the Fed does start cutting, you don't get the benefit on the upper side.
Right,
so I threw a lot in there, kind of all related to the consumer. So I'd love to get your thoughts.
Yeah, I think the consumer might be better positioned right now than they have been in prior, let's call it slowdowns or wobbly periods. And one reason is if you look at just ARMs as a percentage of mortgages, it's like we're in a different world. Like I think in the U.S., 15% of mortgages are adjustable rate. The rest are fixed. So the idea here is that homeowners have a stay of execution. They can figure out how they're going to navigate rising interest rates as we get to that point. The second thing I would look at is, I think the wealth effect was scary, and that's why I worried about the consumer last year, because I thought the market was going to move lower, even lower than it did. And we actually saw a pretty strong rally in the fourth quarter. I think the wealth effect is less important than having a job. So where you're seeing spending weaken is in those higher income cohorts like Silicon Valley and Wall Street. When you start to see mass layoffs across like middle America, that's when I would worry about the consumer consumption overall. But what's interesting is I think that the job market and the labor market in the U.S. is tight for two structural reasons that have to change in order to see more broad spread layoffs. One is just this great resignation during COVID. People just left, and unless all of those early retirees come back and start looking for jobs, that's going to remain relatively tight. And then the second is immigration policy, where our legal immigration policy is pretty tight today. So I think those are two structural phenomena that are creating a still tight labor market. Average hourly earnings is finally higher than CPI. So real wage growth just inflected positive. And what we've found is that real wage growth is probably the best kind of leading indicator for consumer discretionary earnings growth. So I feel like that's a really important signal that wages are remaining sticky and higher. but actual prices at the grocery store are coming down. So people have money in their pockets. They actually have a little more money in their pockets than they did, a year ago.
So maybe corporate margins take the brunt of the consumer margins. Is that what you're saying?
Well, labor-intensive corporate margins are going to get squeezed. But even labor-intensive... Okay, so this is where it gets really good.
Yeah.
I mean, I feel like there are so many reasons to be excited about stocks today and about corporates because they're focused on all of the right things. So if you think about what companies have been spending on over the last few years, labor-intensive companies have been spending money on automation. So all the automation plays, like in industrials, are just minting sales growth. And labor-intensive companies are finally addressing the idea that it's expensive to hire people and we can do more with less and we're going to get efficient. That's when you typically see multiple expansion in a more pronounced way for companies. So we looked at labor-light companies versus labor-intensive companies. Labor-light companies always outperform labor-intensive companies. It's like a chronic alpha signal. The other thing that we found is that when you're in an environment where companies are actually focused on efficiency and getting less labor intensive, their multiples expand. So I feel like this is the reason to be excited about, old economy, sleepy companies like financial services and, restaurants.
But we've done this before. And so going back to the cycles and remember how it ended. Like, you know what I mean? I'm just saying in the .com. And I think that if you look at the S&P up 16% and you have this Mag 7 that makes up 25% of the weight of that. And then if you look at the NASDAQ 100 and that Mag 7 makes up, 50% of the weight.
Sure, yeah.
That excitement that you're talking about is actually infected the stock market. You know what I mean?
Only in those stocks.
Well,
right?
yes, but it's drawn up, like, you know what I mean? So it's drawn, the multiple higher. And again, we could go back
but
to the
only
equal
in those
weight.
stocks.
Right, only in those stocks. So I get it. Even at the lows in October of 2022, we had this huge differential between these, top 10 stocks and then the bottom 90 in the NASDAQ 100 or the bottom 490 in the S&P 500. And it was crazy. So I guess my question here is, how does this, you sound excited about the long term. We talked about this in June because I think you wrote that note in late June. And I think some of the things that got written up at the time based on what I heard you say and reading the note, the headlines in the financial press weren't as far as accurate about what you thought the near term outlook for stocks were. And I think you're saying that now too, in a way. You're at the midpoint of your S&P 500 range, right? Mm-hmm. Which is basically up 15, 16% on the year. Yet you're really excited about stocks, corporates, and all of this, asset light or product, like you just
productivity
mentioned.
And efficiency.
Okay. So the stock market has pulled forward some of that excitement, in my opinion.
But only in the Magnificent Seven. This is my point, right?
I mean, and so people say this stuff all the time. The market's not a monolith, and you talk about stock pickers. Ultimately, correlations will. You're the quantitative analyst here. They will go to one if there is a reason to sell. Just this week, Apple has sold off $300 billion in market cap off of a headline from the Wall Street Journal about China.
Yeah.
We don't know what's going to happen there.
Exactly.
So this is the largest equity.
It's just a headline.
And NVIDIA sold off 10% in the last week. Okay, so that's $125 billion. And what's the next headline that hits Microsoft? So my point is, if all of those things kind of come together, the market will turn into a monolith. And the stocks that are cheap.
I don't think that's
really
true. I don't. I really don't. I mean, this is where I think that that you can actually make some money.
Yeah.
So I think that what you want to do is look for companies that are neglected. So they're not crowded and they haven't been picked up as part of this AI hype machine, but they're probably doing the right things. Like when you do your channel checks and you talk to management, they're cutting costs, they're being smart, they're thinking about automation, they're spending wisely, they have a good CTO, whatever. And I'm not the fundamental analyst, so I defer to our fundamental folks on that. And then think about the companies that actually stand to gain, not just from AI. AI is part of it, but there's a lot of other kind of efficiency stories taking place right now. I mean, if you look at the kitchen of the average restaurant, it has transformed over the last few years, right? I mean, and that can happen to other industries. Financial services, there's too many people in financial services. We're all going to get replaced by bots maybe, or some of us, probably me, maybe
Danny
not
and
you.
me.
I will, sure.
No, we will.
Yeah.
But I think that what you've got is a streamlining, cost-cutting, efficiency story that is not even close to being priced into what investors are expecting. So we're in a market where I think, to your point, we've lived through one cycle, which was falling interest rates, no inflation. Tech just continued to dominate. Like it was like buy tech and you'll be fine, except for 2001 and 2. We're now in a market environment where I think it's going to become more difficult. Tech companies have to spend money to remain competitive, so it's now an arms race for everybody to be doing the right things, and that's where I think it is really an active manager's market. You should go back in the business. You should get back in there.
Stay tuned on that. But just in general, to go back to your thoughts here, because I think the other big macro issue is yields. And I've argued the same as you. For a while, I'm like, if yields keep moving higher, it's a sign, other than the QT and international banks selling, that maybe the economy is going to be okay. Mm-hmm. And people are scared of higher rates, on the long end more than they are, I think, on the short end for some reason. But how do you play kind of the risk premium, which you've talked about, and then if 10-year yields get up to, I'm not saying they're going there, get up to 6%, God forbid, or 5.5%. Sure.
Yeah.
You're talking about an allocation perspective, really hard at these, in my opinion, at your target 20 times 215. I know you're going to roll to 2024 at some point on your S&P target. You're looking at those two side by side in a dicey economic outlook, right? That's going to have obviously this burning back through the atmosphere of high rates. How do you equate kind of that 60-40 or what are you allocating to bonds at this point, I should say, versus stocks? And what multiple would you put on 2024 S&P if indeed you think we've troughed in 2Q23?
Well, look, I think that on the multiple question, again, you got to break the market into two pieces. There's the Magnificent Seven, which are crazy expensive, and then there's everything else. And if you look at I think we did something where we ran the S&P X the Mag 7, and it's trading at something like 15 times. Mm-hmm. Maybe it's changed a little bit. It might actually be lower today. But, I mean, that's not stretched, and that's in line with the idea that the multiple of the market plus inflation should be something around 20. Close enough, right? We're at 4% inflation. We're at 15 times on the S&P X Mag 7. Mm-hmm. So I think that's the first consideration is I almost feel like we shouldn't even have a target on the S&P 500. We should have a target on the S&P 500 X Magnificent 7. But I'll talk to my boss about that. Back to you. The other aspect is yield. So when you think about real yields, I think the opportunity cost of locking in 2% real yield for the next 10 years is miserable. If you look at that 15 times multiple on the rest of the market, on the rest of stocks outside of the 7, you're getting earnings yield of something like 6%. You're also getting inflation protection because earnings are nominal rather than fixed. So I still feel like, S&P versus 10-year Treasury, no brainer. Why would you want to lock in 2% real yields for 10 years? I mean, that's punk return.
So you said about 235 in S&P earnings for next year, so from 215. So it gets you to a little less than 10% growth. What do you think the S&P 500 should do on that? And you know what I mean? Like
just include the Magnificent Seven for a second.
Throw it back in there. Yeah, well, I think those guys might be going down a little bit more unless they massively over-earn versus expectations, which could be the case. Except that
only NVIDIA did that in this period. Okay, Microsoft sold off 10% after its earnings because they did not over-earn relative to the excitement in and around their suite of AI tools and what they're going to do with OpenAI and the like.
Yeah, exactly. Well, I mean, look, I think that we're at a point where the average portfolio manager has more than 40% of their holdings in just a small subset of stocks. I think it was like 1 out of 5 active funds have more than 40% of their holdings in 5 companies. Mm-hmm. That's a world gone nuts. And these guys they're in a tough spot, right? Yeah. Because they have to own the stocks that are driving the S&P higher because their clients want them to, but they can't buy anymore. They're actually tripping up their diversification requirements. So I think that's sort of the cap on mega cap tech. Sure, they might be core holdings. Sure, they might be the best earnings growth that you're going to see forever. But who's left to buy them at this point, right? Now, if you take the rest of the S&P 500, my sense is that there is a huge underweight in anything with beta or cyclicality. And I think that's the opportunity, because when you look at CapEx, when you look at manufacturing, when you look at this infrastructure cycle, we've got, not only do we have fiscal stimulus where companies are incented from a tax perspective to spend and grow, manufacture and do stuff here, but we've also got this, geopolitical national security risk of IP sitting in China that has to come back to the U.S. So, I feel like there are enough cross currents taking place right now that are bullish for the U.S. economy that haven't necessarily been factored into some of these cyclical companies. Again, I'm not making an economic forecast. I rely on our economists for that. But they're actually pretty sanguine on 24 and 25.
So 2024 again. So if you have high single-digit earnings growth, the S&P 500 as a whole, all 500 stocks, where do you think is the S&P making new highs? 4,800 was that kind of all-time high from January 2022. I mean, I assume you're going to be publishing some sort of price target for the S&P. What is it?
Unfortunately, we have to publish these
ranges.
snapshot price targets, which I think are kind of silly. I mean, right now, I would say with confidence that our best long-term forecasting tool, which is just looking at price to normalized earnings and projecting out returns, is spitting out something like 4 to 5% price returns per annum for the next 10 years. That's not great, but it's still better than real yields, and it's nominal. And then on top of that, you've got dividend growth, which I think could actually surprise to the upside. So, the other aspect that I think is interesting is if you look at performance of the S&P over the last 10 years, a very, very small percentage of total return came from dividends. And I think that dividends and cash return are going to become a much bigger part of the story over the next 10 years.
So real quickly about your excitement for stocks on the longer term, the idea would be dollar cost average in this environment for the equal weight S&P 500, like that sort of thing?
Just buy it now and hold it and set it and forget it. I mean, I honestly think that the best pair trade from an asset allocation perspective is shorting 10-year treasuries and buying an equal weighted S&P 500. I don't know about the Russell because there's a lot of zombie companies sitting in the Russell that have just drifted in there because they're burning through cash and can't handle 5% hurdle rates. But most of the companies in the S&P 500 have cleaned up their acts. Like you said it earlier, energy and industrial companies paid down debt and cleaned up their balance sheets. So, I think this is one of those areas where you could make money just by holding the average company in the S&P and shorting 10-year treasuries. I think the other problem with 10-year treasuries, and I know this is going to sound like un-American, and I'm not un-American, I'm very patriotic, but I think that there's a problem with the fact that our debt to GDP ratio now resembles an emerging economy, right? I mean, how does that resolve itself?
Yeah,
the public sector looks fraught. The private sector looks pretty good.
So I'm going to push back on something you said earlier, and I like where your target is on the S&P because I think you could end up being right on the money. But if the big seven, the magnificent seven, sell off, rest assured there'll be a time period in there, and you're right because it'll be a stock picker's market for where the money goes. I think money flies into treasuries at that moment. And I believe that.
Do?
Well, I just think the knee-jerk reaction won't be. Let me go find. This is my opinion. I'm just giving, okay. Yeah. And I could be wrong.
This is how our bet started.
Exactly.
And she won.
I like it. I like it.
Yeah.
From a retail perspective, forget about the institutions. That own our
It's going to spook investors.
It will spook investors. Therefore, everything will kind of come out, in my opinion, and there'll be a time frame.
For a short period of time.
We forget. I know that stock picking is a lost art. I know there are stock pickers out there that should have their list ready. And this is what we try to do on the show, is to prepare people for those exact moments that you're talking about. I just think it pays to be a little bit patient on that, because if that does start to happen, right, I just believe it'll spook a lot of people. It'll hit confidence in the market, and the wealth effect will turn around and go the other way. There will be things. I just believe that if the Magnificent Seven sell off, all I'm saying is this, into the puzzle, 10-year yields will come in. Because I believe people will say, all right, let me take a deep breath, institutions, let me park it, some of this stuff in bonds where they can allocate accordingly, the global funds that are out there that can kind of do it. That's what I see happening. But
I think they're already parked in bonds.
I don't
though.
think I'm just saying yields are high enough here that if you really believe there's a contraction coming, and again, a stock price doesn't dictate contraction. So just because Magnificent Seven sell off doesn't mean, but it could be the realization that growth is not eternal. That, you know what, the market's going to have a check back here. I'm just saying that structurally, I think we're set up in that way where that occurs. But I could be wrong. I'm just saying, but I like your target on the S&P.
I get it. I mean, So look, if I had a target on the S&P X Magnificent Seven, I would say that I think it could actually do. I think our models are saying, like, from a valuation perspective, it could outperform the S&P by like 15 percentage points.
Yeah.
So that's a pretty healthy.
Yeah, I think it's
spread.
under by 10 for the year right now. So it should flip for sure. So.
All right. Well, one last thing before we get out of here. Let's talk about China. Again, we started by talking a little bit about Apple and just the saber rattling that's going on. I mean, to me, when I think of, three companies that are part of that Mag 7, they're three of the biggest components of the S&P 500. It's Apple, it's NVIDIA, and it's also Tesla. They make about 13% of the weight. I mean, they're next. You know what I mean? Like, as far as all these sorts of concerns are. And how worried are you about the deflationary readings that we're seeing in China? That, you know what I mean? Like economic data, it just seems like the export data is bad. It seems like they're going to export deflation. We have Europe that's already in a tough spot here as it relates to inflationary readings, but also growth. How important is China right now? And do you think our market participants are paying enough attention?
Yeah, I mean, I think China is a concern, right? I mean, China was the engine of growth for 20 years, and now it's starting to really look a bit scary. I do think that companies have already started to cut ties with China. So when you look at this reshoring theme, our economists are showing us data where, all of the economic activity that was taking place between the U.S., half of it has been moved to Canada, Mexico, other regions of the world. So there's that. We've already started to sort of decouple from, or disentangle our supply chain from China. Direct sales exposure of the S&P 500 to China consumers is about 5% or less of total sales. So it's a manageable risk. It's mostly in tech, which is, again, another reason I don't love tech. I think tech has been the poster child for everything that's gone right over the last 20 years that's about to go wrong. Deglobalization, higher interest rates, it's harder to grow your business, hurdle rates are that much higher, no more free money. But I think outside of those areas, we've got an environment where companies are already incented and doing the things that they need to do to sort of drive that.
And all those things are very inflationary in an environment where
they're
rates are high.
They're inflationary for the U.S. Yep.
Yeah, so they're inflationary for the U.S. and we don't have the end market, let's say, that you might have. 20% of Apple sales come from China. That's an important number.
I mean,
and think about Tesla. I
me.
mean, 50% of their future sales are expected to come there, not just access to rare earth materials and manufacturing and the like.
But their end market,
right?
Is
so if you lose
there.
that engine of growth, and then we've talked a lot about the precedent that had been set by U.S. multinationals pulling out of Russia when they invaded Ukraine. I mean, like China to me seems like a very underappreciated thing. We could go on and on about that. Well, listen. Savita,
I think it's important. I do. But I think that the U.S. has enough idiosyncratic benefits that we can navigate this. And I think that U.S. corporations are actually in a pretty good position today after most of the really debt-ridden ones have been starved of capital and forced to clean up their acts.
Yeah, well, we're going to be forced to clean up our acts pretty soon, Danny, over here. I mean, listen, I'll lose a bet any day to Savita on national TV if she'll come back on the podcast. So we really appreciate you being here and talking about another brick in the wall of worry, because that's pretty cool. She wasn't even born when the wall
Pink
came
Floyd.
out, was she?
Yeah.
No, I don't know. Were you?
Yes,
Probably was.
I'm 51.
What?
I'm 51.
Oh
yeah.
Okay, that's crazy. I'm 51. I'm 51 soon. So
There you go. See, I'm older than you. You should listen to your elders.
Yes, she doesn't look it though. I'll tell you that. All right. Well, listen, Savita, we really appreciate you joining us on the tape.
Yeah, it's great to be here.
Thank you.
Thanks for having me.
Thank you.
This was fun.